$1.25 trillion. That is how much Americans owe on their credit cards right now. Not mortgages, not car loans, just credit cards. It went up 5.9% in 1 year, and it is still climbing. The average American carrying a credit card balance owes $6,618. That is not a shopping spree. That is groceries, car repairs, doctor bills, the everyday stuff that did not wait for payday. At 21.52% interest, the average APR right now per LendingTree, that $6,618 balance costs $1,390 per year just in interest. That is money that buys nothing. It just keeps the debt from growing faster. 33% of people who carry a credit card balance say groceries, childcare, and utilities are the main reason they are in debt, per Bankrate 2026. Not luxury purchases. Basic monthly expenses that outran the paycheck. 41% of credit card debtors say an emergency expense started their debt. A medical bill, a car repair, a home repair, per Bankrate. One unexpected cost, one swipe, and then the interest starts running. People in their 50s carry the highest average credit card debt of any age group, $9,200 per Experian. That is a generation that has been absorbing higher costs for longer. The debt did not appear overnight, it compounded. Adults in their 30s carry an average of $6,600 in credit card debt, per Experian. The average monthly minimum payment on that balance? $132. Pay only the minimum, and it takes more than 7 years to pay it off, with $3,610 in interest on top, per WalletHub. Banks set the interest rate on your card. Right now, new credit card offers are averaging 23.75% APR, per LendingTree Q1 2026. That is the rate being offered to new customers today. More than $1 in $5 borrowed on a new card is pure interest cost every year. Q1 2021, $770 billion, the pandemic low. Q4 2025, $1.28 trillion. Q1 2026, $1.25 trillion. That is a 63% increase in 5 years. The line dips slightly in Q1 every year. Holiday spending clears. Then it climbs again every summer. $1.25 trillion in credit card debt did not happen because Americans stopped being responsible. Prices rose faster than paychecks. The gap had to get covered somehow. For tens of millions of households, the credit card became the gap. If you want to see the real numbers behind the headlines, subscribe to the Data Desk and hit the bell so you never miss a breakdown. The grocery bill went up 25% since 2020. Rent went up 32%. Car payments hit $767 a month. The credit card balance grew right alongside every one of those numbers. While the debt was climbing, savings were falling. The personal savings rate dropped to 4.0% in Q1 2026, down from 6.2% just 2 years earlier, per the Bureau of Economic Analysis. Americans are earning more on paper, they are keeping less of it. In Q4 2025 alone, Americans added $44 billion to their credit card balances to cover everyday spending, per AInvest. That is not debt from reckless choices. It is the math of a household where the bills grew faster than the income available to pay them. Consumer sentiment hit 53.3 in March 2026, per the University of Michigan. Below 60 is the level they define as recession-like gloom. Unemployment is only 4.3%. Americans are not out of work, they are out of breathing room. The balance is real, the interest is real, but the direction this number moves next depends on what 100 million American households do at the next swipe. Part 2 shows the full cost of staying in the minimum payment trap and the data on who it hits the hardest. Emergency expenses, 41% of all credit card debt. Day-to-day costs like groceries and utilities, 33%. Retail purchases like clothing, 10%. The numbers show a clear picture. Most of this debt is not optional spending, it is survival spending. The car breaks down. The medical bill comes. The roof leaks. None of those events come with a payment plan. The credit card absorbs the hit first, and then the interest clock starts. At 21% per year, ticking every single day the balance is not cleared. Paying only the minimum on $6,618 at 21% takes 7 years and 3 months to clear, and costs $3,610 in interest on top of what was borrowed, per WalletHub. That means the original purchase effectively costs 54% more than the sticker price once interest is added. 7 years. That is the timeline for minimum payments on a balance most Americans would call ordinary. During those 7 years, life keeps happening. More bills, more emergencies, more swipes. The balance rarely gets a chance to actually drop. The average credit card debt for college students is $3,280 per college finance. For many students, the card starts as a safety net. Within a few years of graduation, it becomes a regular part of the monthly budget and one of their biggest sources of financial stress. Americans paid $253 billion in credit card interest and fees in 2025 alone, per 101 Financial. $253 billion. That is not money spent on goods or services. That is money paid to card issuers for the right to carry a balance, collected in small monthly chunks from 100 million households. Medical bills drove 12% of emergency credit card debt, per Bankrate. Car repairs, 8%. Home repairs, 8%. These are not one-time events. They are recurring categories. Every American who owns a car or rents a home will face all three, multiple times per decade. College students, $3,280. Adults in their 30s, $6,600. Adults in their 50s, $9,200. The balance grows with age, not because spending habits get worse, but because more years of absorbing rising costs means more years of carrying the gap on a card. People in their 50s holding $9,200 in card debt at 21% are paying $1,932 per year in interest. Money that should be going toward retirement. The savings rate at 4% nationally means most of them are not building a cushion at the same time they are paying that interest. Disposable personal income rose to $23,506 billion annually in Q1 2026, per the BEA. Incomes went up. The savings rate still fell to 4%. That tells you exactly where the extra income went, straight into the same rising costs that drove the debt in the first place. 83% of Americans think the government should put a cap on credit card interest rates, per WalletHub 2026. President Trump called for a 10% cap in January 2026. As of May 2026, no cap has taken effect. The average rate is still 21.52%, and the banking industry spent $500 million lobbying in 2025. A 10% rate cap would save the average household carrying $6,618, about $723 per year in interest, based on the difference between a 21% and 10% APR. That is $723 back in the household budget. Whether Congress acts on it is a separate question. The math is settled. 4.8% of all household debt was late on payments as of early 2026, per the NY Fed. Student loans are at 9.6% delinquency for 90-plus days. The people struggling most are carrying multiple types of debt simultaneously. The credit card is just the most expensive layer. How much do you carry on your card right now? Drop the number in the comments. Just the balance, nothing else. The range across the country is wider than most people realize. Part 3 has the data on what actually works to get out, and how long it realistically takes depending on where you start. Q1 1999, $478 billion. Q4 2008, $866 billion. Q1 2013, $660 billion, the post-crisis low. Q4 2019, $927 billion. Q1 2021, $770 billion. Q1 2026, $1.25 trillion. Every recovery produced a new peak. This one is the highest. The debt has climbed for 25 years, with one meaningful dip, after the 2008 financial crisis, when lenders tightened standards sharply. That was the last time the number went backward. There is no sign of that kind of correction now. The fastest available tool is a balance transfer card. Some offers run 0% APR for 12 to 21 months. Moving $6,618 to a 0% card and paying $310 per month clears it in 21 months with zero interest, saving more than $3,000 versus the minimum path. Calling your card issuer and asking for a lower rate works more often than most people expect. About 70% of people who ask get a reduction, but fewer than 1 in 4 ever make the call, per creditcards.com. Moving $6,618 from 21% to 10% saves $723 per year in interest, without paying down a single dollar of principal. That is a phone call or a balance transfer. The math works even if Congress never passes the rate cap. The debt avalanche, paying minimums on all cards and putting every extra dollar at the highest rate card, minimizes total interest. On $10,000 at 21%, adding $100 above the minimum cuts the payoff from 7 years to under 4. 3 years of interest saved. Nonprofit credit counseling is free in every state. These agencies negotiate directly with card issuers to reduce rates to 6 to 8% through a debt management plan. The the fastest legal path to reducing interest while paying the balance down. Every new purchase on the card resets the interest clock. Removing the card from your wallet, or freezing it, is not about willpower. It is about eliminating the variable that keeps the balance from falling in the first place. Total debt, $1.25 trillion. Average balance, $6,618. Average APR, 21.52%. Annual interest on that balance, $1,390. Savings rate, 4.0%. 5 numbers. One clear picture of where American household finances stand in 2026. The $1.25 trillion national number will not move because of one household. But $1,390 in annual interest on one balance is very movable. Through a balance transfer, a phone call, or a debt management plan, each balance can move independently of the national total. Paying down card debt raises your credit score, which lowers rates on every future loan. A 50-point improvement on a $400,000 mortgage saves roughly $80 per month. The benefit of clearing card debt reaches further than just the card itself. 3 things move the number. Stop adding to the balance, reduce the rate wherever possible, attack the highest rate card first. The data does not promise it is easy. It confirms it works every time someone applies those 3 steps consistently. The savings rate at 4% means most Americans have almost no cushion for the next emergency. Even $1,000 in a separate savings account removes the most common trigger for new card debt, the unexpected cost with nowhere else to go. $1.25 trillion is the national number. Your balance is yours, and the math on what to do with it is clear. What is the first move you are making on your card this month? Drop it in the comments, and we will see you in the next data file.